Welcome to the Mentis podcast. Today we have Brooks Healy, who is a founding partner of Harborstone Advisors. Thank you for joining us today.
Yeah, thanks for having me.
Yeah. So you have a ton of experience in the Maryland markets and have been in the multifamily game for a long time. Can you give us an idea of what we should expect? Kind of coming out of inflation and these higher interest rates. When do you think we're going to see it kind of a pivot? Maybe with the Fed coming down later this year or just stabilizing? Like what should we expect coming into the second half of 2023?
Yeah, it's certainly been a pretty interesting last couple of years with the macroeconomic environment and rising interest rates more recently and kind of what that has done with deal flow. With our experience in the multifamily market, we had a pretty big skid in the start of the fourth quarter of last year. Things have started to pick back up because rates have ticked back down a bit. But my anticipation is that we'll see deal volume kind of pick up here towards the middle of this year, certainly into the end of 2023 into 2024. But good news is deals are still transacting. We are seeing more sellers kind of meet the market and have the understanding that rates do have a major impact on pricing. But yeah, my expectation would be that these rates will start to cool a little bit. They'll stabilize and hopefully come down slightly, which will get some of this money off the sidelines, which has been patiently waiting.
So you're thinking, or you're seeing that sellers are starting to have a little bit more of an exhale, kind of a moment. They're like, all right, well, I'm going to have to sell it at a lower cap rate, higher cap rate.
Higher cap rate.
Yeah, than expected, but lower pricing than what they might have been able to get a year ago. Is that where you're seeing the major difference, or are you seeing people just willing to underwrite a little bit tighter? Like, what is making these things move forward?
Yeah, it's a little bit of both. I mean, general pricing expectations, or pricing as a whole has kind of come down 10 to 15% from where it was about a year ago. There were a couple instances that we saw specifically in October, November of 2022, where, sellers had a pretty steep pricing expectation and we're getting debt quotes that have just gone up dramatically over a course of a few weeks where, they wanted to get a deal done, but they were going to have to give something up. So we did see some of those deals actually transact with some significant pricing decreases. New deals that we brought to market in the fourth quarter, beginning of this year, we've had some pretty frank conversations with sellers that they're not going to get the pricing that they did a year ago. And most have been understanding of that because, you're seeing more and more of how rates and inflation have impacted things. Certainly there were some high dollar sales in the beginning of last year and obviously in the end of 2021. But I think that time is come and gone. We will see as rents have, increased quite a bit than pricing has, but rents have began to cool. And obviously rates have gone up quite a bit from where they were a year ago. So folks have been a little more understanding than that on that piece, which has allowed these transactions to continue to move forward, although they may have not been at the original expectation when they put them on the market.
I've heard I actually heard that a lot recently, that people are saying that rents have cooled on the annual increases, which to me, it always, it's an interesting point because in a lot of the deals that we're underwriting, we're not really underwriting gangbuster rent growth. And a lot of the folks I know aren't either. And I don't think the banks are allowing them. So that doesn't seem like it would impact a deal getting done. I mean, it's kind of just like, that's the upside. Are you saying that maybe a lot of the people who were buying this stuff were potentially, counting on 5-6%, or like that seems extremely aggressive on the underwriting side?
Some were, especially when a lot of these rent moratoriums were coming up, and there was such a lag in rents in the market where you couldn't raise it once kind of COVID onset, and then they began to ease, and you got to see these major increases in the rent to, above the typical 3 to 5%. So,
and for clarification, you're saying not there's no renovations going, no value add being in, like no value improvement to that apartment, just simply one year to the next, 6,
And
10, 20% increase.
in the core markets that we operate in, where people weren't able to raise rents for 18 months, you did see some of those in properties that they didn't have to spend a lot of capex dollars to achieve those rents. So that happened very quickly, and you saw some sellers try to take advantage of that by achieving these higher rents, which thus would allow them to hopefully sell their building for more. Now we're seeing that rent growth obviously kind of slow down a bit, where it's not north of 5%. It's your typical 3% or so annually, which now is again back to impacting the pricing. So you're not seeing these huge bumps that you did in a short period of time that occurred a year, 18 months ago.
I see, you're making that full circle there for me.
Yeah.
When I see it, a lot of sometimes sellers aren't actually achieving those higher rents before they sell it, and then people are underwriting thinking that they're going to get those higher rents. But what you're saying is that you are, I guess, as the seller's representative, had sellers who were achieving maybe, I don't know, 10% of the units at a much, much higher valuation.
Yeah.
And the story was to the buyer, hey, this is going to be an amazing deal for you. I got you.
Yeah, there've been a couple transactions we sold that they had historically we're raising rents annually, then things stopped, and the market that they were in was a very good market, and they didn't raise rents for 2 years, and then they put a couple capex dollars into a unit and were able to achieve $500, $600, $700 bumps for these kind of unique units, and they did it 2 or 3 times, and it was a powerful story to the buyer, saying that, look, I can come in here without spending a ton of money, and upon renewals get a big bump in rent, which obviously helps push the price point a little bit. So we saw that happen quite a bit in the last 12 months. Moving forward, you're not seeing as high rent growth in most areas that you did, just because there was that slowdown. So it's obviously stabilizing right now, and values are stabilizing. It's again down about 10% from what we saw with the rising interest rates. But as a whole, there's still some of that uncertainty, and there's certainly a lot of money on the sidelines, just waiting for some consistency in the market to jump back in.
There does seem to be quite a bit of hesitancy from a lot of groups, just a lot of pencils down, especially on the banking side, just kind of slower, less bullish underwriting. Talking to a lot of loan officers who are really, eager to do some deals, but the bank is kind of holding back a little bit.
We've seen some lenders, specifically on that kind of balance sheet side, or small community banks, who are coming to us and saying, look, there is no negotiation in some of these terms. Usually, depending who the borrower is, you can kind of work with that, but because of where the market is and some of the uncertainty, they've got to kind of stick to their form. We saw this month Freddie Mac and Fannie Mae have announced some significant decreases in their interest rates for the month of February. So that's getting some people excited for the deals between 1 and 7-8 million, which hopefully some people can take advantage of and get some of those dollars back into buying some of these mid-size apartment deals.
Certainly would be nice to see some volume pick back up, but
yeah,
everybody had free money essentially for a long time. Never seen anything like this. Got to have the medicine on the other side, and we'll certainly see the other side of this downturn as well. So probably something that's not something that's brought up a ton, but I want to get your take on technology disruption. The real estate market historically has not been like leading the pack with technology disruption, and I think a lot of that has to come down to the fact that it's hard to scale. Every deal is different, so it's hard to scale like in a very replicatable way. Certainly, you have your niche, like certain asset classes, and there's a lot of research companies out there now that are providing a lot of good data that is certainly disrupting the way we're doing things to to what was done in the past. But how do you see potential like artificial intelligence impacting the real estate world at all? Are we going to go to a brokerless society? Are loan officers not even going to be needed anymore because the bank can program a computer to get it all done? I'm trying to figure out, where does this early onset of chat GBT like kind of stuff, where does that take us 5 to 10 years from now? I mean, this is kind of just forecasting the future a little bit, but at the beginning of the internet, people would have never guessed some of the stuff that we're able to do now. And I'd just like to see if you had any thoughts or could weigh in on that conversation.
Yeah, Chat GPT has gained a lot of traction, as a lot of people have seen, and I don't think we'll be in a brokerless society. I don't think we'll ever be in a loan officerless society. It's always going to take that human interaction, specifically to get deals done. I think these artificial intelligence websites like Chat GPT or these apps that will be coming out are going to be super beneficial, not only to brokers and lenders, but I think also to buyers, developers. That my understanding of it is how you can program it to fit your line of business, and the more information that you give it, it can make you certainly be much more efficient and hopefully successful. I think that in the brokerage world, it's going to help out from a marketing standpoint. It's going to help out from an underwriting standpoint. Since at least with our firm, we're so hyper focused on multifamily, we can hopefully build some sort of tool through AI, which will help us, with our underwriting quickly, with our marketing packages. I think even from, a title standpoint and other partners that are involved to get a transaction done, it could hopefully make things much more efficient. It can make things happen quicker, from a transactional side of it. But yeah, it's going to certainly be a disruption. I think it'll be a pretty good disruption. But
Yeah, you seem positive. You're like, you see this
I
as like
am.
a
Yeah,
welcome. Yeah.
I've been doing a lot of research to it, and there's a lot of inefficiencies in the brokerage and transaction world. Deals being delayed for certain things, and there's so many different moving parts. So I think if there's anything that can help with efficiency in transactions, and even from and just in the brokerage world, marketing, speed to getting things to market, especially because the lending environment is changing very rapidly, it'll help our customers out. But yeah, who knows? I mean, this thing could morph into something that's very, very powerful. I don't think from a job standpoint it's going to do a ton to that. I think folks that use virtual assistants and rely on things like that are not super hands-on, it may hurt the virtual assistant world. So that would be interesting, because we utilize folks like that. But yeah, I think
agree. I agree that the brokerless society is not,
it's not going to work.
It's not on the horizon.
No,
it's the people behind the deals that make all of these things happen. I mean, yeah, there is the fundamentals that you have to hit in certain deal metrics, but the people and the little moving parts and the nuances is what I think really makes.
Yeah, I think it's
real estate.
I think it's exciting. I've started to do some research on it, and again, you're seeing more of it in the news and publications and people's takes on it. I like to do things as efficiently as possible. I don't like delays. I like being on time. So I think it's a tool that could certainly help my business and all my clients for that matter.
So I've looked at it in a little bit different light. I think I apply the AI technology to what it can do to the robotics industry. And the robotics industry could potentially make construction significantly more affordable, which could bring a lot of new product online at a much lower cost. And this might not happen or might happen, but I've always thought if you dramatically decrease the cost of construction, one, whoever creates that robot will be the world's next multi-billionaire.
Yes.
Two, you will disrupt one of the largest segments of our economy, and that's all of the debt and the valuations of all of the properties that are out there. I'm not sure that it'll happen, but I think there's two sides of it, at least from my initial take on it. Is one, you could potentially build better buildings, and the overall value could just go up overall, and more people, like 200 years ago there wasn't air conditioning in a building, but maybe there's a new invention that comes with a robot helping build something for cheaper. And then the other side is, I think that you might be able to I don't know, renovate existing properties a little bit more efficiently, and then those properties will maintain their value. So you could be negative or positive on it. I guess it really just depends how you look at it. But the way I was looking at AI, I kind of led you down the broker road, because that's kind of the world you live in. But I looked at it and I was like, I don't know if it's going to affect maybe the white collar folks that are involved in real estate as much as it will affect the blue collar folks who are
Sure.
critical right now. And I don't know. Any thoughts on how it would impact maybe the construction industry?
Yeah, I think that anytime you bring robots into play, they're gonna be more efficient than us as humans. So certainly it's gonna be a massive learning curve. Again, you always are gonna need eyes and ears and hands and feet on the ground for all these projects. But the ultimate goal for a lot of this stuff is efficiency. So I don't know if it will have an immediate disruption in the construction world. The part in construction that I see that it could have probably a pretty big impact is project management. You look at some of these articles on what this technology can do, and it has a lot where people can, as long as you put in good information, it can plan everything out. It can, maybe make your timelines and things either aggressive or a little bit more smooth. So I think operationally it'll be an asset to the construction world immediately. I don't think it's going to have an impact on employees quite yet, but who knows?
Yeah.
I mean, this thing could gain a lot of momentum, and from what we're reading and understanding, it's just going to continue to get smarter.
Yeah, I don't think this is an immediate tomorrow, next year, maybe even 5 years from now. But we all didn't have smartphones 15 years ago.
Yeah,
and now
quick.
A lot of the stuff can kind of gain traction quickly. All it takes is one really, really pivotal invention, and we'll be
the adoption rate of ChatGPT is going to be quicker than probably anything we've seen. I saw some stats about it versus how quickly it got to 1 million users versus YouTube, Netflix, iTunes, things like that really revolutionized the technological world. So I think it's going to be an interesting ride. I think it's going to be a unique tool, and certainly can update in a year. Maybe we can circle back and see what's changed as this becomes more widely available.
That sounds like a great idea. Well, we have a new governor here in the state of Maryland, Governor Wes Moore, from Baltimore, and seems to have a lot of great energy. And regardless of political affiliation, I always like to give our politicians the best chance and wish them well, because it really kind of does matter for the trajectory of our state. Do you have any insight on potentially where he and his team are going to be focusing, and is there any type of advisement to the folks who are looking to invest into Maryland and new projects or I guess new zones that are targeted?
Yeah, I mean, Larry Hogan did a great job in the overall business community in Maryland and really helped turn things around. Governor Moore does bring, as you mentioned, a ton of really good energy. I think he's got a great backstory. I really hope, and he did make a lot of comments about having Baltimore be a major focus of his governorship. So getting Baltimore, which drives a lot of Maryland, and we do a ton of business in Baltimore. So we hear it from folks from out of state, folks locally. The taxes are super high in Baltimore. The crime is out of control. The schools are horrible. So I hope their biggest impact, as throughout his term, is really hoping that he can work with city government, give the city, the things they need to help turn it around in regards to crime and schools, and not penalizing property owners through these crazy high taxes that are throughout the city. So that would be my hope. I'm hoping that he can make some actions here in it's only been a month, but in a short period of time, to help reduce crime and make the city, which is a great place to be, just a little bit cleaner and better.
I remember, well, for one, I've been in and out of Baltimore my entire life, and I grew up a Baltimore Orioles, diehard Baltimore Orioles fan, watching Cal Ripken and watching the Ravens, and love the city and what it could be. But I remember the first time I was in a southern city, like I remember Charlotte, and driving around, I'm like, the roads are really smooth here. I'm like, oh my gosh, the city can actually keep their streets clean and they can keep them smooth. And like, it just kind of opened my eyes to the fact that there is a lot of stuff to happen in Baltimore. I know you do a ton of transactions there, but it seems like the story has been the same for a long time, that it could be better. It should be better.
Yeah.
So are people, like, where are people investing right now in Baltimore to make sure that they're not kind of seeing the negative side of investing in that city?
Sure. Yeah. I mean, the core markets that most folks, either local investors or people that are from out of state that want to be, have a good asset that's protected, that cash flows well, are mainly throughout the main corridors of Baltimore, which essentially is from downtown up to Charles Village. Areas on the northwest and northeast, southwest, are certainly troubled markets. And if people don't have the expertise in working with, high crime areas, or a mix of voucher tenants versus market tenants, or don't have management experience, it can be very difficult. And most of those folks tend to learn pretty quickly that they've got to be, pretty hands-on. So neighborhoods like Mount Vernon, obviously the waterfront neighborhoods are also the best in the city. There's not a ton of kind of what we focus on, which is middle market multifamily deals, 10 to 150 units. It's a lot of single family and larger institutional multifamily assets. But the buildings that we sell in Mount Vernon, Station North, Charles Village, have all done very well, and their rents have stayed. Downtown markets rents have been hit a little bit, but there should be hopefully some nice expansion there, with Harbor Place being redeveloped in the near future. So those areas they all do very well. You typically see your higher price points there, but investors are safe, and there's always going to be a stable demand for renters because of the hospitals and the colleges that are right within the heart of our city.
It truly is a well-positioned city with, the ports and some of the best healthcare in the world, and
yeah,
you're right outside of DC, and you've got some of the highest paid counties per capita right out, right on the perimeter. It's got a lot going for it. I just think it needs to gain some traction. We've done some deals there in the past, and it was eye-opening, I think, is the way I would say it. It's tough, and I think that like you were saying, finding the right neighborhood, working with somebody who really knows the ins and outs is almost, you have to, otherwise you can really get in trouble.
And a lot of folks come to Baltimore chasing yield, right? It's a lot of DC, New York, Philly investors that have an existing portfolio that they're maxed out in their home markets. So you can certainly get a higher cap rate deal in Baltimore versus those. Your rent growth is not going to be as high as those cities, but it's going to be stable. If you're in a good market, you can typically get very strong tenants. The renter pool is not diminishing by any means. There are some areas of the city that are certainly being hurt from a population decrease, but the core markets have seen some steady growth. And ultimately, with a new governor, maybe some new changes in Baltimore, we hope that population growth in the city can improve and certainly increase.
Well, I appreciate your perspective on that, and we wish Governor Moore the best. Hopefully, he has a very successful term. What do you believe we learned switching here back to the pandemic and kind of inflation and these rising interest rates? What do you think we should have taken away from that, or what have we learned so that we all can avoid potential pitfalls in the future?
I guess from an inflation standpoint is, it was great that there was essentially free money, but that's probably not going to come around again. So, folks that have these, at least from the investor side, it's, kind of having the premise and the understanding that rates will never probably be that low again. If they do go that low, then we're going to probably see some trouble in the immediate future, which in the short term we've learned. We saw the spike in the interest rates. So understanding that from an investment standpoint, and as you're tracking rates and as you're tracking transactions, understanding how that's going to impact your future underwriting. From what we saw in the brokerage world and what everybody saw was obviously an immediate shakeup in March of 2020. Multifamily persevered along with kind of the industrial market, probably better than any other commercial asset type. So I think specifically in regards to multifamily properties, it's going to continue to be strong. There's some other assets within multifamily that also did well, like single family rental portfolios. We're still seeing that the properties that we're selling with larger units, or even on the single family side, that allows people to have a little more space, especially since more people still are continuing to work from home. Not many kids that are going to school from online anymore, which is a good thing. But those assets have done pretty well.
That's a fascinating point. A lot of people, the smaller home, trend was, we can.
It was big, yeah.
Yeah, it was big, and then you can make these teeny little units. So you're saying that didn't play out?
What we saw in between, I'd say, June of 2020 to really up to now, since rates have kind of gone up, is we had assets that were kind of townhome style, and you're seeing a lot of people even now develop a lot of these, build to rent large townhomes that in certain markets are doing very well. The properties that we sold that were larger, that either had big apartments that, despite really what their rents were, or townhome style, it received the most amount of activity from the investor side. People understood that, look, a lot of people aren't going to the 9 to 5 every day or sending their kid to school. They needed more space. The units that had that, like we sold a townhome community in Laurel, Maryland in the summer of 2020, and an international buyer bought it. It's a super unique market, but everyone that looked at it loved the fact that it was a 4-bed, 3-bath type of unit. Everybody had their own space. Everybody was doing their own thing. So that was certainly unique to see. And then the single family rental portfolio market did very well over the last couple of years. We're starting to see that slow down a little bit, but just so people had enough space, and I think that made investors feel comfortable. There was a high demand for people renting those types of units, so there was very little vacancy time. But yeah, that was something that was certainly unique to us for the properties that we marketed during that time frame.
Yeah, so that 1960s, 1970s vintage really kind of sticks out as like larger units, in my mind, maybe even the 80s. But developers these days, I mean, shoot, I in my office, I'm looking at an architect who's bragging about how efficient he can make the space and how tight it can get.
And that's something that obviously is certainly important right now because the cost of construction is so high.
So is this going to be a continually diverging issue?
It could be. Yeah. I mean, from our world in the brokerage world and the properties we've sold, the ones that had the larger floor plans within the last 2 years did very well. The properties that had some smaller studio units, if they weren't in a market that didn't have a lot of that inventory of it, people certainly discounted that quite a bit. But I think because of the, work from home and go to school at home model was so prevalent, and people were seeing that shift, that it got people to, one, be a little more aggressive in pricing. Two, the demand for people that were calling us saying, look, I'm looking for townhome style. I'm looking for things that, may not be in a high rise versus, I want a garden style asset because they have larger floor plans. We were kind of, scratching our heads being like, what are we not catching on to? And then we would target some properties to sell like that, and they all did well. So that was certainly unique. It's still there for sure. But I think from the development standpoint, just because the costs are high, obviously you want to be as efficient as possible, but you're still going to get people attracted into those smaller units. It just certainly depends your market.
I really appreciate that point of view. Not something I've heard recently. It seems like common sense. People actually like to have space. It's like
everybody was stuck up in a house for a while, so the more space, the better. And again, that was just kind of a reaction we saw pretty quickly into the height of the pandemic.
So would you rather have an asset with a large balcony, or would you rather see an asset with small balconies or no balcony and maybe like internal little office space that,
I guess are you talking more of kind of a garden style building or a high rise?
I'll leave it up to you. What would you recommend is like, if you're building?
I think I mean, garden style buildings, I think a lot of people like to have their a little bit of space outside. A small deck is fine. If you're in a high rise, you certainly can have areas in the building where you have that maybe amenity that everybody can have access to. But it's also helpful, a lot of those people that would rent those units have it be students or young professionals that have the ability to work at home. It's nice to have that separate office space as well. So I think it really depends. Some markets just don't have the exterior space in some of their high-rise buildings besides a common area. So, and people like to be now even more than ever, since a lot of people were cooped up for a while, is be around people. It adds, a nice amenity for people to socialize.
Makes sense. It makes sense. Well, over the next, I guess, 3-4 months, we're going to see a little bit more of a rate jump is what we're expecting. Second half of 2023, bring this back full circle. You're expecting that transactions will pick up, but do you expect the Fed will hold rates through the rest of 2023, or do you think that they're going to shift and start to maybe even cut rates as soon as the end of 2023?
Conservatively, I'd say they'd probably keep them held.
I think that's what the market seems to be.
Yeah, I don't think that jumping too soon to cut rates, I don't think would make a ton of sense. But
so with that in mind, is there a product type or a financing solution that you're recommending or that you're seeing people use to get deals done or starting to put in place? Are they going to life companies? I think obviously prepay is going to be the issue, is if you lock yourself into this higher rate and then you're you're kind of stuck into it. And if rates come back down in the next few years, you're going to be really kind of wishing you hadn't.
Life insurance companies have been involved in a bunch of our transactions, so that's certainly an alternative. As I mentioned earlier, the Freddie and Fannie programs have just knocked rates down quite a bit for the month of February. If they continue to do this, I know they left a ton of money on the sidelines last year, so that could be something for investors to really keep a pulse on, have it be for a refi or just an acquisition. So I think those programs for the kind of the space that we specialize in make a lot of sense. For the deals that have a heavy value add component, we are seeing, the hard money route, and then people, getting super aggressive on the refi to try to get that long-term rate lower.
Okay, but they're getting aggressive. How? What are they doing? They're
meaning that they're going to, go and obviously with hard money, it's going to be a significantly higher rate.
Of course,
do what they can to minimize their construction costs, but also raise rents as high as possible to refi the most amount of money that they can pull out of the project at obviously a lower rate than the hard money loan. Have that be through a Freddie or Fannie program if it fits, or a life insurance company, or a local bank. That's going to be the opportunity that most people are going to leverage.
Yeah, it's going to be interesting to see if there's, I guess a loan product that makes it a little easier. But the banks, it's good to be the banks. The banks don't have to. Obviously a lot of people are going to shy away from maybe a variable interest loan without a cap on it. But the banks, even if they give you a fixed, let's say they were to give you if they were to give you a variable rate loan today, they're still going to put a floor on it, and they're not going to let that just go all the way back down. They're still going to you're still going to have to get out of it. So I don't know, it's certainly something to watch as we move forward. But I
would agree.
Well, I appreciate you joining us today, giving us some quick insight on Baltimore and on the multifamily space. Is there anything else that you would recommend we pay attention to get an edge for the next 20, or for the rest of 2023?
I mean, it's continuing to track those rates. I will say that the activity has certainly picked up this year in regards to, I guess, in comparison to the last quarter of 2022. So there is still a good deal of competition out there. We had just to give you an example, we have a 96 unit garden asset that our offers date was last week, and we saw 9 offers. 4 of those, came in with a significant non-refundable deposit upon contract signing. So there's still competition out there. I think going through the rest of this year, you may see a little, stress in the market. You may see some distressed assets come up. We just sold one last week, which was 32 units. But again, that got 10 plus offers. So you may see some of the properties that have kind of variable interest rates, or properties that had a high level of delinquency, or they were non-recourse and the seller just kind of transitions out, come available, which could be a good opportunity. So the light and heavy value add opportunities are obviously a good place to start if you've got the capacity to do some renovations and add value, and then refi in a short period of time. So continue to track the rates. Sellers are open to conversation if they're putting the property on the market, so do not shy away from that. And we're always happy here to assist and give you our insights, what we're seeing as the most part of the whole in Maryland and Southern PA for where we focus.
So if somebody has an asset or is looking to buy one, where should they reach out and get in touch with you?
Yeah, they can go to our website, which is harborstoneadvisors.com. And all of our contact information is there. All of our current opportunities are there as well. So you can browse and see the different apartment buildings that we're selling throughout Maryland and Southern PA. Obviously, if you have an asset in those markets and are considering selling or want to know what it's worth, we're happy to provide you an opinion of value and give you our kind of take on what the market could bear for getting that asset off your plate.
Well, appreciate you joining us and wish you well in the rest of the rest of this year. I think it's going to be a good end, regardless of the headwinds that we're all facing. And we'll catch up with you soon to check on those AI predictions.
Yeah, let's follow up soon and see how this impacts everything. But no, I appreciate you for having me on. And as always, it's great to talk to you tonight.
Thanks. Talk to you soon.
All righty. Thank you.